We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Britton Financial Partners. The next one, Ben, we're going to jump into one of our deeper dives. But what we're going to try and do is we're going to get in too much trouble if we go too deep on this. We've got the topic we're talking about is a small business capital gains tax concessions. Now, this couldn't be further apart from our initial topic of investing, investing in different asset classes or different types of investments. I suppose what we're trying to do here is just let people know that might be in this circumstance that haven't maybe sought advice, or they think that maybe this is going to be suitable for them, to actually seek advice. So this is definitely not us providing advice around what people should be doing with their small business assets if they sell them. But let's have a crack, Ben. If we get too deep, we'll just delete it, hey?
Yeah. I was going to say with this, I think one of the biggest things that I want to sort of made it topical is clients in recent history where they weren't aware of these things, so the conversations weren't had in advance of selling that asset or selling that business venture. So they didn't know what they could do until it was too late. And these are probably, in my mind, just about the most favourable tax rules we've got from small business. Realistically, you're talking about people being able to wipe out. I've got a client recently in the works at the moment where it's literally $1 million decision on yes or no of this rule, if you can apply this rule or not. So we're talking about significant savings for people who've been in business, worked their whole life in a business. They've accumulated assets around it. When they leave it, they don't really want to leave a chunk of it to the tax man. Mm. They want to be able to roll that through potentially into super, potentially into something else. So again, we're probably at risk of going very deep very quickly. Maybe we'll just step back and just talk through what that sort of means.
One of the interesting things before we do that is that you mentioned that a lot of the clients or individuals that this might be suitable for are people that have maybe not had a lot to do with super in the past. They've invested their time and energy and sweat into building a business, and when it comes time to sell it, they probably don't have the understanding, or like almost 90% of the time they don't have the understanding. They maybe not have an appreciation of how super can benefit, but also how you can make use of
even the concessions. An extension to that is some accountants haven't had a lot to do with this, and some planners haven't had a lot to do with these rules. So you find you need to be sourcing information from multiple different places to actually get these right. So we're probably fortunate, maybe mainly from the shepherding connection, probably with farming, and that's probably one of the biggest industries that make use of these rules, but also lots of other small businesses where we've been around this a fair bit and we've used it to clients' advantages a lot of times. Some accountants are all over it as well. Some of them, that's just not their wheelhouse, so they're not as across these rules and what can be applied. So I think being ready for this in advance and sort of knowing where you're going to go with it is the most important part. Sometimes you got to, sort of got to polish it up to make sure it is, ripe to be using these rules. So I think the biggest thing about it's probably that 15-year part, would you say? Do you think that's probably the biggest?
Well, if you don't meet that, then you're out. Yep. Let's take one step back. So we've got we've got a bunch of strategy papers on this. As we were researching how we'd talk about this, we've got about 25 strategy papers, of which are about 20 pages in length for each component of this concession. So we're literally just going to give the high-level overview. So I'll start here, and you interrupt me, Ben, if you think I'm gearing into dangerous territory. But so when business owners are looking to dispose of their business assets, usually as a part of their retirement plans, two major considerations often come into play, and they are managing any capital gains tax from the disposal of the asset and maximising their tax-effective retirement income. I'll keep reading and you just cut me off, Ben, when you're ready. It's not surprising, therefore, that it is in retirement situations that the small business CGT or capital gains tax concessions are particularly valuable. This is because, number one, any CGT liability generated by the disposal of a business asset can be potentially reduced, deferred, or eliminated if the qualifying conditions for these small businesses concessions apply. Number two, depending on which concessions apply, the business owners may also become entitled to the use of the lifetime CGT super contribution cap. I'm going deep already.
I was going to say, if we sort of just like Just loop back around those couple of points there. First of all, it's about reducing tax to leave the most left in your pocket. The second part is, okay, where does that go next? This is probably my biggest opportunity to roll a massive sum of funds into super. So generally speaking, we've got caps of 27,500 per year and 110,000 per year as well of contribution caps normally. These caps are massive. I think we're up now above 1.42 or something. It's a massive
1.615.
1.615. Yep. So it's very obscure numbers, but 1.615 of contribution cap that we potentially open up for these funds to pass through. So
yeah, above and beyond the normal caps, yep. Which not everyone, but most people who are in tune with their super are aware of. So it's massive.
It's a huge thing. So you're talking about no tax and getting it into the most tax effective environment all in one hit. It's almost, you probably read it and think it sounds too good to be true. Maybe at some point they'll end up winding it back. But while it's open and available, we need to be making sure that anyone who can use it does use it.
This last point on this page was just about, which is what I said at the beginning, the availability of the CGT cap is especially important where a business owner's main assets are tied up in their business and they don't otherwise have significant amounts accumulated in super. Like how many, farmers...
So the farmer said, what's he say? He says, my land is my super. That's
it. But even the small business owner says the same thing. The small business owner says, listen, my business is my super. I've put everything that I've got back into that and I figured that one day I'd sell it. But in selling it, we have that conundrum of dealing with the potential capital gains tax. And if it's left unreviewed, the implications can be pretty massive. All right. Do you want to talk about the 4 concessions that are potentially available? So you mentioned right at the beginning. So the first one. So on disposal of a business asset or a qualifying business asset, there's 4 small business concessions that are potentially available. So the first one, Ben touched on, which is a 15-year exemption. So
it's all like the holy grail of them all, the 15-year rule. Basically, if you think about it, you've owned the asset for 15 years is where that term comes from. Generally speaking, it needs to have been active for at least 7.5 years of that time, or as a minimum. And you need to be over age 55 at the time the asset is disposed of. So you've got to tick some boxes. And that might be, if we sort of looked at it from a strategy point of view, they've owned the asset for 14 years. Well, maybe they need to stick at that for another year because literally could be hundreds of thousands of dollars saved by just going that extra year. And that's what's super important. You get these things right from the outset.
Well, that point is that it's not just about making these decisions when it's time to sell. In advance of that, and maybe multiple years in advance of that, you think about again, we're going to get dangerously deep into territory, but imagine the farmer or someone that owns land that is not generating an income, has done for a number of these, so they qualify for nearly half of the qualifying period, and they just need to generate a little bit of extra income to make sure they qualify. Well, if they come and speak to us, we're going to probably encourage them to make sure that they meet that criteria because it can be an absolutely massive benefit to them. So the 15-year exemption, certainly for the likes of the small business owners that have had assets for a long time, and the farmers that have an asset, they tend to be the ones that we see. Would you agree?
Yeah, 100%. That's definitely, and that one is, again, whenever you can use that, it's always good. It feels good when you can get someone to transition out of their small business where they're, like you said, their blood, sweat and tears has gone into.
Yeah.
And pretty much most of the time, if they've got everything set up correctly, roll straight into pretty much a passive income in retirement or do whatever they choose to do in that next phase of their life. So that's sort of the first one. The second one, again, some people not necessarily being applicable for the 15-year rule, but there's a lot of people are aware if you own an asset for over 12 months, so when you go to sell it, you get a 50% reduction in the capital gains calculation. Being an active asset, you simply apply another one. So you can apply a secondary 50% reduction, which again, pretty significant money being chewed away at in that regard. So you've sort of got, again, another rule that people don't understand CGT at the best of times, but if you start talking about 50% reductions with another 50% reduction, you're starting to chop into a lot of that tax cost.
Yeah, which is why do we want to give the tax man more than he deserves?
Suppose that one often links through to the third one being the retirement exemption. So sometimes people exit a business in relation to retirement when they're not yet 55 years old. So again, the 55 and over links well to the 15-year exemption. The 55 and under links to the retirement exemption. So this provides a different cap, which is a $500,000 flat cap that can collect those contributions of the taxable portion. So again, without sort of playing it through with numbers, if you think about it, if you had a $2 million gross capital gain, you get a 50% reduction to $1 million, you get another 50% reduction to $500,000. You then roll that $500,000 into super.
It's a lovely round number.
And you've got
that worked out perfectly.
Yeah, I prepared that earlier. You end up with no tax. So, and it's all about balancing it up, because you're going, all right, well, if I'm under 55 and I'm making this decision, I'm actually locking those funds away until I'm 60. So again, there's layers. You got to go, right, I tick the box for that, tick the box for that. Yep, I've got enough other funds that I can move through, put that 500 in, invest it for the next 5 years or 6 years or whatever it may be till I get to age 60, and I know it's there for later on. So that one's a little bit of that deferred reward we talk a lot about as well, is that you might have to look at moving it in there to then access it in the future. So I think, again, underutilized, underappreciated rules, maybe.
You want to roll, mate? So let's go to number 4.
We'll go down to the CGT rollover relief. And to be honest, this one is one I haven't seen used as often. Have you had any clients using? I've had one in the last 2 years who's used it.
No, most of the time it has been getting it into super. It hasn't necessarily been rolling into another replacement asset.
And again, sometimes this one can even just be used to, again, a lot of business sales and property sales have long settlement periods. So sometimes you have sold an asset, you've got potentially have a tax liability that's been raised, but you haven't yet received the funds for that sale as well. So you can actually use the rollover relief to push it out, to defer to the years till then you receive your proceeds to then be able to fund your tax bill, which is never pleasant. But again, it's all about pulling on levers you've got available. You need to shuffle some things around. It gives you some time to move, and timing is crucial. I think we've probably touched on that more than I thought we would, but about being ready ahead of time, being aware at the time you sell, and then knowing what you'll do in the time between then and settlement to make best use, because all of these rules, without going down that rabbit hole, have timing issues and you've got to make sure you're right. It happened on the 30th of August this year. Well, when have we got to get the funds and get it rolled into into the fund? So this often overlays with developers and people, or business purchasers have long settlements. So again, I think you can probably sense this is stuff you don't want to be trying to do alone.
No, and I think we've said it enough. We'll say it again. You got to get advice around this stuff. And timing, you're right. We probably had said that more than we anticipated, but it's true that you got to give yourself, and you got to give whoever's giving you some advice time to line all the ducks up. Because if you don't, it's like anything that's time critical related to maybe the end of the financial year, give yourself some time. Give your advisor some time, give your accountant some time to actually work through those numbers, because otherwise you either miss the opportunity or you make bad decisions because you've got to make them with haste. So I think we did an okay job, mate, of not going too deep there. But again, what are we trying to say to people? If you've got a small business, you've got a farm that you've held for many years and you're thinking about winding into retirement, you should be talking to someone. You should come and have a chat with us.
One of the other things, just as a final point on that, I know, and this probably from family and friends being from the farm, is that sometimes people don't want to actually redeem that asset, that they just want to migrate the asset into a tax-effective position. So there's a parcel of farmland, again, I don't want to harp on about farming, but it can work for other businesses too. But if you've got a piece of land and you go, I don't want to sell it, I just want to lease it out to the neighbour and he's going to pay me a nice return and that's going to be some of my passive income in retirement. Well, you can actually align these things to move that asset from your own name into a super environment where then you can collect the income without a tax burden. So again, I know that's sort of going right down the strategy path, but people probably think, I don't want to sell it. I've owned this business.
So that transfer of that asset is effectively the trigger event.
Yeah. So and again, there's a fair bit of back and forth in the courts.
And this is not advice.
Definitely not advice. But there's many ways that you can do that. So I've had clients where they've, progressively purchased the property off themselves over a period of time with a longer contract. Some people have been able to transfer it straight in and purchase it off themselves. There's a whole list of different ways you can do it. But again, you've got to get your timing right. You've got to get your plans in order. But for people that have big assets, potentially they end up paying tax for the rest of their life by leasing an asset out that they own personally when they could have, at the right time, moved it into a tax-free environment and then continued to own the asset. They might have derived income from it for another 10 years. And then when they sell it, there's no CGT either. So you can sort of the best of both worlds if you get that right. So again, don't get caught up in the fact that I have to be selling this. I know some people, they might just, move out of that, off that premises or move out of the business in some regard, want to retain an interest in the asset. So again, we have a few different ways we can go with that.
A CGT event's not always the sale of the asset. It might be a transfer of asset from...
Change of ownership, essentially.
Change of ownership.
Yeah.
Is there anything else we want to touch on there? Have we've skirted around the edges enough and said enough times that this is not advice? Come and see us.
Yeah, and I think one of the biggest things is we, as a business, as planners, we want to work with you and your professional. So a lot of clients might come in fresh, but they've got an existing relationship with an accountant. We need to be working together to get that best outcome across the board. We need to work with them very, very closely on items like this. And if we can get a good relationship with them, it just makes it a much better experience for everyone. So I think that's crucial that we're here to work with your current team of professionals if you've got them around you. Hopefully you do. And you really need to have a group of people making these decisions that they're not one individual can do on their own anymore.
Yep. Couldn't agree more. And I think we'll probably talk about that on a future podcast, the importance of having the right professionals around you, your legal, your accounting, your financial advisors, property advocates, all the above. So we hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.